Nobody's panicking right now. That's the problem. Every major financial collapse in history began this way. Calm markets, confident experts, and a system quietly locking itself into failure. The next crash won't begin with fear. Fear comes after the mechanism activates. And this time, the mechanism isn't housing, it isn't tech stocks, it isn't even debt. It's the structure of the market itself. What you're about to hear is not a prediction. It is a walkthrough of a system that now contains multiple built-in failure modes, any one of which can trigger the rest. And once that chain starts, there is no manual override. In 2008, we were told the crisis was caused by bad mortgages, people borrowing money they couldn't afford. That explanation was convenient. It gave the collapse a villain. But mortgages were only the spark. The explosion came from something far more dangerous, something most people still can't explain clearly. Derivatives, not stocks, not bonds, contracts, bets layered on top of bets. By the time Lehman collapsed, the global derivatives market had grown so large that even a small failure cascaded into a 20 trillion meltdown. And here's the part most people don't know. That system was never dismantled. It was rebuilt, more complex, more leveraged, and far less visible. A derivative is not complicated. It's deliberately made to sound complicated so fewer people question it. A derivative is a contract whose value depends on something else. You don't own the thing, you own the outcome. A farmer locks in a price for his crops. An airline locks in fuel costs. Used correctly, derivatives reduce risk. But that's not what dominates the market anymore. Speculation does. Today, most derivatives are not used by producers or businesses. They're used by traders, betting on price movement. And here's where the danger enters. Leverage. Leverage allows someone to control a massive position with very little actual money. A 5% move in the wrong direction doesn't cause discomfort. It causes liquidation. Now scale that across banks, hedge funds, pension funds, and market makers, all using similar models, all reacting to the same signals. That's not diversification. That's synchronization. In 2008, the system broke because mortgages failed. But the real disaster came from what was built on top of them. Mortgage-backed securities, collateralized debt obligations, credit default swaps. Each layer moved risk further away from visibility. By the time the underlying loans failed, no one knew who owed what to whom. Trust vanished. And without trust, the system froze. The government didn't bail out homeowners. They bailed out the bookies. Because if the insurance failed, every major bank failed with it. That was the lesson. And Wall Street learned the wrong one. After 2008, regulators tried to force transparency. Central clearing, capital requirements, stress tests. But the most profitable trades didn't move into the light. They moved into exemptions, into private agreements, over-the-counter contracts, family offices, swaps no one was required to report. The risk didn't disappear. It went dark. In 2021, one man exposed how dangerous that darkness had become. A single-family office used a derivative called a total return swap to secretly control over $100 billion in stock exposure. No disclosures, no public filings. No one knew the size of the position until it collapsed. Multiple banks discovered, at the same moment, that they had all made the same bet with the same counterparty. Losses exceeded $10 billion. One of those banks never recovered. Credit Suisse died 2 years later, not because of one mistake, but because confidence never returned. That's what hidden leverage does. It doesn't just cause losses, it causes disbelief. But even that wasn't the most dangerous evolution. The real transformation happened quietly. Wall Street figured out how to monetize calm. They created products that profit when nothing happens. Volatility suppression became a trade. For years it worked. Markets stayed calm. Central banks injected liquidity. Risk appeared gone. And so leverage increased again. Then came a warning shot. In 2018, volatility spiked briefly. Not a crash, just a bad day. But the system reacted violently. Products designed to profit from calm were forced to unwind automatically. Selling triggered more selling. Billions vanished in hours. No panic, no headlines. Just machines executing logic faster than humans could intervene. That was Volmageddon, and it proved something critical. The market can now destroy itself without human emotion. Since then, the risk hasn't decreased. It's multiplied. Commercial real estate is now approaching a refinancing wall. Trillions in loans written under zero-rate assumptions are coming due in a world that no longer exists. Buildings are emptier. Cash flows are weaker. Interest rates are higher. Defaults are already happening. Those loans sit inside securities owned by pension funds, insurers, and regional banks. And on top of them, credit default swaps. Insurance on failure. Someone is selling that insurance. Someone always is. And just like 2008, we don't know who holds the exposure or how leveraged they are. At the same time, a new weapon has been attached to the core of the stock market. Zero-day options. Contracts that expire the same day they're created. They now represent over $1 trillion in notional value every single day. This isn't investing. It's structural stress. Market makers hedge these contracts automatically. That hedging moves the market, which attracts more bets, which forces more hedging. A feedback loop. On calm days, it amplifies gains. On bad days, it accelerates collapse. A normal 1% drop can turn into a 4% crash. Without news, without fear, without a single human decision. Just math. Now connect the pieces. Commercial real estate stress triggers bank concerns. Banks wobble. Markets dip. Zero-day options amplify the move. Forced selling accelerates. Somewhere in the shadows, a highly leveraged fund loses collateral. Margin calls begin. A counterparty can't pay. Trust breaks. Liquidity disappears. And suddenly, no one knows who is solvent. That's not a theory. That's how the system is wired. In 2008, the Federal Reserve had room to act. Rates were high. They cut them to zero. They printed trillions. They bought time. Today, inflation already exists. Rates are already elevated. Printing again saves banks, but destroys the currency. Doing nothing preserves the currency, but collapses the economy. There is no painless option left. The fire department is trapped in the building. This is why the next crisis won't look like 2008. It won't have a single cause. It will be multiple independent failures aligning at the same moment. And by the time it's obvious, the mechanism will already be running. This isn't about fear. It's about understanding the structure you're standing on, because complexity itself has become the risk. If this analysis helped you see the system more clearly, subscribe. This channel exists to map the risks most people are never shown. Stay skeptical, stay unleveraged, and remember, calm is not stability.